doing well with money has surprisingly little to do with how smart you are, and almost everything to do with how you behave. Personal finance is overwhelmingly taught as a hard science grounded in math, formulas, and rigid economic models. Yet, real-world financial decisions are rarely made on spreadsheets. They are made at dinner tables and in corporate meeting rooms where personal history, ego, pride, marketing, and unpredictable incentives collide. The text covers the introduction and chapters 1 through 9 of Morgan Housel's The Psychology of Money. Introduction: the greatest show on earth, core narrative and case studies. The premise of the book rests on a striking dichotomy between two vastly different financial outcomes. First, the tech executive versus Ronald Read. A wildly successful technology executive patented a key Wi-Fi component, founded and sold multiple companies, and became immensely wealthy. However, his relationship with money was dominated by insecurity and reckless ostentation. He carried inches-thick stacks of $100 bills, once handed a valet thousands of dollars to buy $1,000 gold coins, and skipped them like rocks into the Pacific Ocean just for fun. He replaced a broken $500 hotel lamp by throwing a $5,000 stack of cash at the manager. Within years, he went completely broke. Ronald Read, on the other hand, was born in rural Vermont and was the first high school graduate in his family, hitchhiking to school daily. He fixed cars at a gas station for 25 years and swept floors at J.C. Penney for 17 years. He purchased a 2-bedroom house for $12,000 at age 38, lived there for the rest of his life, and chopped firewood as a primary hobby. When he died in 2014 at age 92, the humble janitor made international headlines. He had quietly amassed an $8 million net worth by saving small amounts and investing consistently in blue-chip stocks over decades. He bequeathed $2 million to his stepchildren and over $6 million to his local library and hospital. Another example is Richard Fusconi. In contrast to Read, Fusconi was a Harvard-educated Merrill Lynch executive with an MBA who retired in his 40s as a celebrated philanthropist. Fusconi borrowed heavily to build an 18,000-square-foot mansion in Connecticut, featuring 11 bathrooms, 2 pools, and maintenance costs exceeding $90,000 per month. When the 2008 financial crisis hit, high debt and illiquid assets forced him into bankruptcy, foreclosure, and the public auction of his estate for a quarter of its insured value. Housel notes that a genius who loses control of their emotions can be a financial disaster. The opposite is also true. Ordinary folks with no financial education can be wealthy if they have a handful of behavioral skills that have nothing to do with formal measures of intelligence. Key principles finance is not like physics or surgery. You cannot have a janitor perform a better heart transplant than a Harvard surgeon, but a janitor can easily outperform a Harvard MBA in investing. Financial failure is driven by loss of emotional control, greed, and lack of humility, while financial success is driven by patience, endurance, and behavioral discipline. We are taught finance through mathematical formulas like laws of interest rates, cost of capital, and asset correlation. But knowing what to do tells us nothing about how we behave under stress, fear, or temptation. Analytical commentary. The contrast between Ronald Read and Richard Fusconi encapsulates Housel's fundamental thesis. Intellect and financial literacy are poor predictors of wealth accumulation. The financial industry sells the illusion that market performance is a game of analytical supremacy, encouraging retail investors to buy complex products and trade actively. However, money is an amplifier of human behavior. Intelligence without psychological discipline leads directly to leverage, hubris, and ruin. Ronald Read did not win by outsmarting Wall Street. He won by removing himself from the behavioral traps of lifestyle inflation and modern consumerism, letting time handle the heavy lifting. Chapter 1. No One's Crazy Core Narrative and Conceptual Overview. Your personal experiences with money make up roughly 0.000000001% of what has happened in the world, but dictate roughly 80% of how you think the world works. Every financial decision a person makes sense to them at the moment, because it is filtered through their unique mental model of reality, shaped by their generation, upbringing, local economy, and personal luck. Generational expectations vary dramatically. An individual born in 1950 experienced a stagnant S&P 500 during their formative teens and 20s, adjusted for inflation. An individual born in 1970 saw the S&P 500 surge nearly tenfold during their teens and 20s. These two groups walk through life with fundamentally opposing views on stock market risk. Inflation leaves deep scars. Someone raised in 1960s America saw prices triple during their young adult years, experiencing gas lines and shrinking paychecks. Someone born in 1990 grew up with low inflation and may never consider price instability when making long-term investments. During the 1960 presidential campaign, John F. Kennedy admitted he had no first-hand knowledge of the Great Depression because his family possessed one of the world's great fortunes. He only learned about the economic catastrophe by reading about it at Harvard. Consider the paradox of lottery tickets. In the United States, low-income households spend an average of $412 a year on lottery tickets, 4 times more than high-income households. Simultaneously, 40% of Americans cannot assemble $400 in an emergency. While spending safety net funds on a one-in-a-million gamble appears irrational to affluent observers, for low-income buyers, a lottery ticket represents the only tangible purchase of a dream for the financial stability and luxury that wealthier citizens take for granted. We are also financial newbies. Modern personal finance concepts are brand new. The retirement safety net is barely 2 generations old. Before World War II, most workers labored until death. The 401k was created in 1978. The Roth IRA was created in 1998. Index funds are less than 50 years old. Expecting humans to navigate these modern financial tools with perfect rationality is like expecting an animal domesticated recently to lose all wild instincts. Spreadsheets can model the historic frequency of big stock market declines, but they cannot model the feeling of coming home, looking at your kids, and wondering if you have made a mistake that will impact their lives. Analytical commentary. This chapter dismantles the arrogant condescension often found in traditional financial advice. Financial commentators frequently label lower-income workers as irrational for purchasing lottery tickets or taking on subprime loans. Housel forces us to adopt an empathetic lens. Economic behavior is rationalized through lived history. A spreadsheet cannot quantify fear, economic shame, or the generational memory of poverty. Recognizing that no one is crazy prevents us from judging others' financial strategies while encouraging us to audit our own biases. We are all acting on incomplete data filtered through our tiny slice of lived experience. Chapter 2. Luck and Risk, Core Narrative and Case Studies. Luck and risk are directional doppelgangers. Both represent the fundamental reality that every outcome in life is guided by forces other than individual effort. You are one person in a world of 7 billion people, operating within an infinitely complex system where uncontrolled external factors frequently outweigh conscious actions. In 1968, Bill Gates attended Lakeside School near Seattle. Bill Duggal, a math teacher, petitioned the Mothers Club to spend $3,000 from a rummage sale to lease a teletype Model 30 computer connected to a mainframe. In 1968, there were 303 million high school-age people in the world, 18 million in the US, and only 300 attended Lakeside. Gates had a 1 in a million head start. Gates himself noted that if there had been no Lakeside, there would have been no Microsoft. Gates had a brilliant classmate and best friend at Lakeside named Kent Evans. Evans possessed a lawyer-like business mind, equal technical talent, and shared Gates's boundless ambition. However, before graduating high school, Evans died in a mountaineering accident. The odds of dying on a mountain while in high school are roughly 1 in a million. Gates experienced 1 in a million luck. Evans experienced 1 in a million risk. Consider the thin line between genius and crime. When advised that his railroad expansion deals violated New York statutes, Cornelius Vanderbilt reportedly snapped, "What do I care about the law? Ain't I got the power?" His ruthless disregard for outdated statutes made him a legendary tycoon, but a slight shift in court enforcement could have branded him an outlaw. John D. Rockefeller frequently broke laws to build Standard Oil. Historians praise his cunning visionary tactics, yet a minor shift in judicial timing would have framed him as a common corporate criminal. Benjamin Graham, the father of value investing, built the majority of his career wealth through a single, massive position in Geico, a move that explicitly violated almost every diversification rule Graham laid out in his own textbooks. Key rules for navigating luck and risk: be careful whom you admire. Avoid studying extreme individual case studies like Rockefeller, Bezos, or Buffett. Extreme outcomes require extreme ends of luck and risk that cannot be reliably replicated. Focus on broad patterns. Look for common, repeatable traits across broad samples, rather than outlier anomalies. Never assume 100% attribution. Success is rarely 100% effort, and failure is rarely 100% laziness or stupidity. Bill Gates once said that success is a lousy teacher because it seduces smart people into thinking they cannot lose. Analytical commentary. We systematically understate luck when we succeed and overstate risk when judging others' failures. Attributing someone else's success to luck feels bitter and jealous, while attributing our own failure to bad luck feels like a cop-out. However, acknowledging the presence of uncontrolled variance is essential for risk management. If you view success as purely a product of skill, you build brittle financial strategies that leave no buffer for bad luck. True financial maturity is recognizing that the game can flip coins against you even when you make the mathematically optimal move. Chapter 3. Never Enough: Core Narrative and Case Studies. When wealthy people do crazy things, it is almost always because they lack a sense of enough. Housel illustrates this with a conversation between authors Kurt Vonnegut and Joseph Heller at a party hosted by a billionaire hedge fund manager on Shelter Island. Vonnegut remarked that their host made more money in a single day than Heller had made from his novel Catch-22 over its entire history. Heller replied that he had something the billionaire would never have: enough. Housel presents two devastating real-world examples of failing to understand this concept. First, Rajat Gupta. Born an orphan in Kolkata, Gupta rose to become CEO of McKinsey, retired to advise the UN and World Economic Forum, worked closely with Bill Gates, and sat on the board of directors of 5 major public corporations. Worth an estimated $100 million by 2008, he was comfortably in the hundreds of millions circle. However, he desperately wanted to enter the billionaire circle. In 2008, Upon hearing confidential board information that Warren Buffett was investing $5 billion into Goldman Sachs to save it during the financial crisis, Gupta called hedge fund manager Raj Rajaratnam 16 seconds after hanging up the board call. Rajaratnam bought the stock immediately, making $1 million in quick profits. Both Gupta and Rajaratnam were convicted of insider trading, destroying their careers and reputations. Second, Bernie Madoff. Long before running the largest Ponzi scheme in history, Madoff built a legitimate, highly profitable market-making securities firm that siphoned 9% of the New York Stock Exchange's trading volume. His legitimate business generated between $25 million and $50 million in pure profit annually. Yet, Madoff threw away his legal fortune, freedom, and family honor to run a fraud. 4 critical rules of enough. 1. The hardest financial skill is getting the goalpost to stop moving. If your expectations rise in lockstep with your results, striving for more yields 0 additional satisfaction. 2. Social comparison is a game you cannot win. Comparing your lifestyle to others is a ceilingless ladder. A rookie baseball player earning $500,000 compares himself to Mike Trout, earning $36 million a year. Trout compares himself to top hedge fund managers earning $340 million a year, who compare themselves to top fund founders earning $770 million a year, who look at Jeff Bezos. The only way to win is to refuse to play. 3. Enough is not too little. Recognizing enough is not conservative martyrdom. It is the realization that an insatiable appetite will push you to the point of catastrophic regret. 4. Non-negotiable assets exist. There are vital things never worth risking, regardless of the potential financial gain, reputation, freedom and independence, family and friends, being loved by those you want to love you, and happiness. Analytical commentary. The urge for more is rooted in evolutionary biology, but uncurbed, it destroys financial security. Modern capitalism is an extraordinary engine for creating wealth, but it is an equally powerful engine for manufacturing envy. Gupta and Madoff did not suffer from financial illiteracy. They suffered from emotional poverty. They risked assets they had and needed, such as freedom, prestige, and peace of mind, for assets they did not have and did not need, such as additional millions. Defining your personal threshold of enough is the single most crucial guardrail against self-inflicted financial ruin. Chapter 4. Confounding, Compounding Core Narrative and Theoretical Foundations. The physical world provides profound lessons on exponential growth. For over a century, scientists struggled to explain the cyclical occurrence of Earth's 5 ice ages. In the early 1900s, Milutin Milankovitch determined that the moon and sun's gravitational pull gently alters Earth's tilt toward the sun. Russian meteorologist Vladimir Koppen realized the true catalyst: moderately cool summers, not freezing winters. When a summer never gets warm enough to melt the previous winter's leftover snow, that remaining snowpack reflects sunlight, lowers local temperatures, attracts more snow the following winter, and compounds into miles-thick continental ice sheets over centuries. This persistent, tiny leftover snowpack is identical to financial compound growth. Consider Warren Buffett's age curve. Of Warren Buffett's $84.5 billion net worth, $2 billion was accumulated after his 50th birthday, and $81.5 billion arrived after he qualified for Social Security in his mid-60s. Look at the counterfactual math. Buffett started serious investing at age 10. By age 30, he had $1 million, or $9.3 million, inflation adjusted. If he had acted like an average person, exploring options in his teens and 20s, starting with $25,000 at age 30, earning his spectacular 22% annual returns, but retiring at age 60 to play golf. His net worth today would be roughly $11.9 million instead of $84.5 billion, which is 99.9% lower. Compare Buffett to Jim Simons. Jim Simons, founder of Renaissance Technologies, has compounded capital at 66% annually since 1988, which is triple Buffett's 22% rate. Yet Simons's net worth is $21 billion, 75% less than Buffett, because Simons did not find his investment stride until age 50. He had less than half as many years to let compounding run. Human intuition struggles with linear versus exponential thinking. Adding 8 10 times equals 72, which is intuitive. Multiplying 8 by itself 8 times equals 134,217,728, which is counterintuitive. In computer hard drive storage, from 1950 to 1990, humanity gained 296 megabytes. From 1990 to 2019, humanity gained 100 million megabytes. Good investing is not necessarily about earning the highest returns. It is about earning pretty good returns that you can stick with, and which can be repeated for the longest period of time. That is when compounding runs wild. Analytical commentary. Human intuition is fundamentally linear. We intuitively grasp additive progress, but exponential growth boggles our brains. Because exponential returns seem counterintuitive, investors undervalue the single most critical variable in wealth generation: time. We endlessly debate asset selection, stock picking, and market timing, hoping to optimize our annual returns by a few percentage points. Yet, adding 10 or 20 years of continuous compounding to a mediocre yield creates vastly superior fortunes compared to chasing high short-term returns that cannot be sustained. The ultimate investing skill is not financial analysis, it is patience. Chapter 5. Getting Wealthy versus Staying Wealthy. Core narrative and case studies. Getting money requires risk-taking, optimism, and aggressive action. Staying money requires the exact opposite: humility, paranoia, frugality, and an acute awareness that luck can take away what it gave. Consider Jesse Livermore versus Abraham Jermonsky in 1929. By 1929, Livermore was the world's most famous short seller. During the October 1929 crash, he shorted the market while others jumped out of windows, making over $3 billion in a single day. Abraham Jermonsky, a multi-millionaire real estate developer who heavily leveraged into stocks during the Roaring '20s, was ruined in October 1929 and walked away into Wall Street, tearing ticker tape to bits, never to be seen again. 4 years later, overconfident from his 1929 windfall, Livermore took increasingly massive, leveraged bets. He accumulated catastrophic debts, lost everything, and committed suicide in 1933. Both men knew how to get rich, but neither knew how to stay rich. Another example is Rick Guerin. In the 1970s, Warren Buffett and Charlie Munger ran investment decisions alongside a third equal partner, Rick Guerin. Guerin was just as smart as Buffett and Munger, but he was in a hurry. During the 1973 to 1974 market crash, which saw a 70% decline, Guerin faced margin calls on leveraged positions. He was forced to sell his Berkshire Hathaway stock to Buffett for less than $40 per share. Buffett and Munger survived because they avoided debt and were never in a rush. When Michael Moritz of Sequoia Capital was asked how Sequoia prospered for over 4 decades while competitors vanished, Moritz replied that they were always afraid of going out of business, assuming that tomorrow would not be like yesterday. The 3 pillars of survival. First, be financially unbreakable. You must be able to withstand market downturns without being forced to liquidate your assets. Cash reserves in a bull market look draggy, but if cash prevents a forced stock sale during a bear market, its effective yield is astronomical. Second, build in room for error, or a margin of safety. You must plan on your plan not going according to plan. The world is unpredictable. A successful strategy must allow for lower than average returns, recessions, or personal emergencies without causing total collapse. Third, maintain a barbelled personality. Keep short-term paranoia alongside long-term optimism. Over the last 170 years, the U.S. standard of living grew 20-fold, despite 1.3 million war deaths, 33 recessions, 4 presidential assassinations, and over 100 stock market drops of 10% or more. Growth occurs amid persistent short-term destruction. Nassim Taleb noted that having an edge and surviving are two different things. Where the first requires the second, you need to avoid ruin at all costs. Analytical commentary. The financial industry prioritizes return optimization over longevity. However, nonlinear compounding depends entirely on uninterruptible duration. Leverage is the primary enemy of financial longevity. Leverage deprives you of control over your timeline. When prices move against you, someone else dictates when your assets are liquidated. To stay wealthy, you must cultivate a healthy degree of paranoia. You must treat cash reserves not as unproductive drag, but as an essential insurance policy that buys time and independence during market panics. Chapter 6. Tails. You win core narrative and statistical realities. In complex systems, long tails, which are the extreme outer ends of a distribution, drive the vast majority of outcomes. A tiny fraction of events accounts for nearly all meaningful results. Consider Heinz Berggrun's art collection. Berggruen fled Nazi Germany, moved to the US, and became one of the most successful art dealers in history. In 2000, he sold a portion of his collection, including Picasso's, Braque's, and Matisse's, to the German government for over 100 million euros, with a private market value exceeding $1 billion. Horizon Research pointed out that great art dealers operate like index funds. They buy massive quantities. 99% of the work turns out to be mediocre, but holding a few tail winners like Picasso yields vast fortunes. Consider Walt Disney. By the mid-1930s, Disney had produced over 400 short cartoons. Most were beloved, but most lost money, leaving his studio near bankruptcy. Then came Snow White and the Seven Dwarfs in 1938, which earned $8 million in its first 6 months. An order of magnitude higher than all prior revenue combined. The 83 minutes of Snow White completely erased years of accumulated losses. Look at venture capital distributions. Correlation Ventures analyzed 21,000 VC deals from 2004 to 2014. 65% lost money. 2.5% returned 10 to 20 times. 1% returned more than 20 times. 0.5%, or roughly 100 companies, returned more than 50 times, driving virtually the entire industry's profit. Look at public stock indexes like the Russell 3000. Since 1980, the broad Russell 3000 index increased over 73-fold. Yet, 40% of all public companies in the index experienced catastrophic loss, declining over 70% and never recovering. All net index gains were produced by just 7% of component companies, such as Apple and Amazon, that outperformed by extreme margins. Consider behavioral timing through the story of Sue, Jim, and Tom, examining $1 invested monthly from 1900 to 2019 across 1,428 months. Sue buys every single month through panics and crashes, ending with $435,551. Jim sells to cash during recessions and buys back when they end, ending with $257,386. Tom panics 6 months into a recession and stays in cash until 6 months after it ends, ending with $234,476. The takeaway is that staying cool during the 22% of months that were in or near recessions accounted for the vast majority of investment performance. Great comedians like Chris Rock performing 50 clumsy, small club trials to find 5 working jokes for a Netflix special, and great businesses like Amazon losing hundreds of millions on the Fire Phone offset by AWS rely entirely on tail event structures. George Soros noted that it is not whether you are right or wrong that is important, but how much money you make when you are right and how much you lose when you are wrong. Analytical commentary understanding long tails reframes how we view failure. Most investors expect most of their choices to succeed, leading to panic, self-doubt, and frantic trading when individual stocks slump. However, tail-driven reality means that being right 50% or even 20% of the time can yield extraordinary fortunes, provided you do not cut your rare winners short or let duds wipe you out. Failure is not an anomaly, it is the default state of business and investing. Normalizing failure allows you to accept losses gracefully, stay invested, and let your few tail events run wild. Chapter 7. Freedom Core Narrative and Social Research. The highest dividend money pays is control over your time. The ability to wake up every morning and say, "I can do whatever I want today," is the ultimate measure of wealth. Psychologist Angus Campbell surveyed thousands of citizens to isolate what made people happy. Income, geography, and education were poor predictors. The single most dependable predictor of positive well-being was having a strong sense of controlling one's life. Consider the mechanics of reactance. Doing something you love on a schedule you cannot control feels identical to doing something you hate. Psychologists call this reactance, which is the innate human resistance to feeling disempowered or stripped of control. Housel recalls quitting a prestigious, high-paying Los Angeles investment banking internship after 1 month because working over 100 hours a week turned a job he loved into a miserable experience. Derek Sivers defined rich on his own terms. Sivers saved $12,000 by living frugally on a $20,000 per year wage at age 22, allowing him to quit his day job and become a full-time musician. Selling his company years later for millions added cash to the bank, but it did not transform his life. The true leap in freedom happened at age 22, when he purchased total control of his time. Consider the modern paradox of knowledge work. In 1955, median American family income was $29,000. By 2019, it was over $62,000 inflation adjusted. We live in larger homes with more bathrooms, better cars, and cheaper electronics. Yet, stress levels remain high. In 1870, 81% of jobs were in agriculture, crafts, or manufacturing, where laborers worked with their hands and left work at the factory. Today, roughly 79% of jobs are in management, decision-making, or services. Knowledge workers carry their tools inside their heads and on smartphones, so work follows them during commutes, dinners, kid bedtimes, and late-night awakenings. Control over time has diminished. Gerontologist Carl Pillemer interviewed 1,000 elderly Americans. Not a single person said happiness meant working as hard as possible to buy luxury goods or matching the wealth of peers. They valued quality friendships, being part of something bigger, and spending unstructured time with family. Pillemer noted that kids do not want your money or what your money buys anywhere near as much as they want your presence. Analytical commentary. The modern economy efficiently channels wealth accumulation into consumption rather than autonomy. We convert our financial gains into bigger houses, faster cars, and status items that lock us into demanding jobs. This creates a high-income, low-autonomy treadmill. True financial independence is not about retiring to sit on a beach. It is about reclaiming agency. Unspent money grants options, the ability to leave a toxic workplace, take a lower-paying job with a shorter commute, weather an emergency without panic, or set your own schedule. Time autonomy is the ultimate luxury asset. Chapter 8. Man in the Car Paradox, Core Narrative and Observational Analysis. While working as a hotel valet in Los Angeles, Housel observed guests driving Ferraris, Lamborghinis, and Rolls-Royces. He noticed a profound psychological paradox. When you see someone driving an expensive car, you rarely think about how cool the driver is. Instead, you think that if you had that car, people would think you are cool. Key principles. The car owner's goal is to be admired, but the observer ignores the owner and imagines themselves in the car. The result is zero actual admiration for the driver. People buy luxury goods to signal to others that they should be liked and admired. But observers ignore the owner, using the luxury good merely as a benchmark for their own daydreams of being admired. You might think you want a fancy car or a huge house, but what you actually want is respect and admiration from other people. Expensive possessions rarely bring genuine respect, especially from the people whose respect you truly value. Humility, kindness, intelligence, and empathy bring far more genuine respect than horsepower or brand logos ever will. Analytical commentary. The Man in the Car Paradox exposes the flaw in signal-driven consumption. We spend hard-earned capital buying status goods to impress people who are far too busy thinking about themselves to care about us. This creates a wasteful feedback loop. We sacrifice long-term financial autonomy to buy physical items that fail to deliver the emotional validation we seek. Recognizing this paradox breaks the cycle of status-driven spending, freeing up capital to build actual financial independence. Chapter 9. Wealth is what you don't see. Core narrative and case studies. Money possesses many ironies, but none is more consequential than this. Wealth is what you do not see. Consider the story of Roger. While valet parking in LA, Housel knew a young man named Roger who drove a brand new Porsche. People assumed Roger was wildly successful. One day, Roger arrived in a beat-up Honda. When asked, Roger casually admitted his Porsche had been repossessed after he defaulted on his car loans. Roger spent his income displaying a wealthy image, leaving himself financially broke. Understand the difference between rich and wealthy. Rich is current income. Someone driving a $100,000 car is rich because they have enough income or credit to afford the monthly payments. But all you know about their finances is that they have $100,000 less than they did before buying the car. Richness is visible. Wealthy is unspent income, unexercised options, financial flexibility, and growth assets. Wealth is the cars not purchased, the watches not worn, the clothes foregone, and the bank accounts untouched. Wealth is hidden optionality. The fundamental paradox of wealth. Because wealth is invisible, it is exceedingly hard to learn from or emulate. We easily see rich people spending money on expensive cars, large houses, and luxury items. However, we cannot see wealth such as hidden bank accounts, growing index funds, and preserved options. As a result, society defaults to mimicking visible spending, confusing rich displays with actual wealth. Spending money to show people how much money you have is the fastest way to have less money. Analytical commentary. This chapter offers a clear definition of real wealth. Wealth is the gap between your ego and your income. Modern culture is structured to praise consumption while ignoring accumulation. We admire people who spend money on visible goods even when that spending erodes their financial health. True wealth lies in hidden options, which are the unspent assets that grant you freedom, security, and time control. To build wealth, you must resist the urge to convert income into visible status displays, prioritizing invisible financial resilience instead. Summary of key takeaways. Introduction. Behavior beats intelligence. Ronald Read accumulated an $8 million net worth as a janitor, while Richard Fusconi went bankrupt as an MBA executive. Financial success is a soft skill dictated by emotional control. Chapter 1. No one is crazy. Personal experiences shape 80% of your financial worldview, from generational stock market returns to lottery ticket buyers. Chapter 2. Luck and risk shape outcomes. Bill Gates experienced 1 in a million luck at Lakeside School, while Kent Evans experienced 1 in a million risk in a mountaineering accident. Outcomes are driven by forces beyond individual effort. Chapter 3. Never enough. Rajat Gupta committed insider trading with $100 million in wealth, and Bernie Madoff ruined a legitimate business. Stop moving the goalposts, and never risk what you need for what you do not. Chapter 4. Confounding Compounding. Earth's ice ages were formed by cool summers, and Warren Buffett accumulated $81.5 billion of his net worth after age 65. Exponential growth requires persistent time, not extreme annual returns. Chapter 5. Getting wealthy versus staying wealthy. Jesse Livermore made $3 billion in 1929 but died broke in 1933, while Rick Guerin was forced to sell his stock during margin calls. Longevity and survival beat aggressive short-term yield. Chapter 6. Tails, you win. Heinz Berggrun's Art Fortune and the Russell 3000 Index show that 7% of components drive all net returns. Long tails drive all major outcomes, and it is normal for most things to fail. Chapter 7. Freedom. Angus Campbell's Happiness Studies and Derek Sivers saving $12,000 at age 22 highlight that controlling your time is the single highest dividend money pays. Chapter 8. The Man in the Car Paradox. Observers do not admire the driver of a luxury car. They imagine themselves in it. Possessions rarely bring the respect you actually seek. Chapter 9. Wealth is what you do not see. Roger's repossessed Porsche shows the difference between visible income and invisible wealth. Wealth is unspent assets and invisible optionality, not spent income. Doing well with money requires less reliance on financial formulas and far more attention to self-awareness, humility, patience, and emotional discipline. Managing risk, defining enough, and prioritizing long-term survival over quick returns allow compounding to work its magic over time. Real wealth is not about showing off what you have spent. It is about buying total control over your time.